Welcome to this explainer. Look, if you've glanced at your phone lately, you know that modern finance has just become completely chaotic, right? You are constantly bombarded by this absolute hurricane of noise. We're talking TikTok influencers promising you can turn a tiny tax refund into massive wealth overnight, AI chatbots trying to manage your retirement, gamified betting markets that are somehow disguised as investing, and of course, real-world geopolitical shocks threatening global stability. It is completely overwhelming. But today we are going to cut right through all of that noise. We're going to use a calm, structured fiduciary framework to identify the actual risks to your wealth and build a really solid defense strategy.
Okay, let's dive into this. Here is our agenda for today. 1. Vetting modern advice. 2. The prediction market casino. 3. Peering into private credit. 4. Geopolitics and your portfolio. And 5. Actionable steps.
So I want to ask you a pretty serious question right up front. Who are you actually allowing to influence your hard-earned wealth? Just recently, a finance channel jokingly announced a beta test for an AI agent named Plain Bagel, basically a deepfake bot that could supposedly give tailored financial advice and even automatically fire the human host. It was a joke, obviously, but it points to a very real, frankly absurd reality we're dealing with now. Millions of people are literally handing their financial data over to AI, or they're taking life-altering cues from influencers in fluffy bathrobes, telling them to just dump their tax returns into high-risk tech stocks.
All right, Section 1. Vetting modern financial advice.
When you actually sit down with a registered fiduciary, they are legally bound by a duty of care. They are absolutely required to understand your specific situation and put your interests above their own. Contrast that with an AI chatbot or your favorite social media influencer. AI models have zero legal liability. If they give you terrible advice, they just issue a generic disclaimer. And those influencers selling you a dream of 10xing your money in 6 months, they aren't fiduciaries either. They're usually just trying to sell you a $20 stock picking course. They don't know your risk tolerance, and they certainly won't be there to bail you out when the market takes a sudden turn.
Now, what's really wild here is the actual failure rate. To put this into perspective, OpenAI recently benchmarked ChatGPT against some challenging finance tasks, and it failed 17.5% of the time. Think about that for a second. Nearly 1 in 5 times, it could be giving you mathematically flawed or completely hallucinated advice. These large language models are prediction engines, right? They aren't judgment engines. They piece together words that sound highly confident and authoritative, but they aren't actively researching obscure economic data or weighing real-world risks. They are a tool for sure, but they are absolutely not a replacement for human financial judgment.
And then, of course, we have the latest social media trap, prop trading. You've probably seen the videos claiming you can easily make 2% a month on a $100,000 account, all using someone else's money. All you have to do is pass this strict little evaluation phase. But here is the deceptive allure behind all that. These firms often make the vast majority of their money off the upfront evaluation fees that you pay them. The parameters to pass are so incredibly strict that almost everyone fails. It's essentially an entire ecosystem built on farming fees from retail traders who are just being sold an illusion of financial freedom.
Moving right along to Section 2, the prediction market casino.
And this brilliantly illustrates the harsh reality behind the marketing. Platforms like Polymarket and Kalshi are absolutely booming right now, and they're heavily marketing themselves to young investors as a smart way to profit off their knowledge of news and pop culture. But just look at the actual data. An independent analysis of Polymarket found that a staggering 84% of users realize losses. Only 2% ever make over $1,000. Research actually shows the median return on investment for retail users is negative 8%. I mean, that is actually worse than traditional sports betting. Despite what the influencers are telling you, these platforms are operating much closer to a casino roulette wheel. They are heavily skewed against the average user because of fees, thinly traded markets, and sophisticated insiders.
You'll see TikTokers drop quotes exactly like this one, basically telling you to day trade geopolitical crises. They'll say, hey, go buy Lockheed Martin stock because missiles were just fired in the Middle East. But guys, this is a totally reckless mindset. By the time a headline hits your feed and you open up your trading app, the big institutional algorithms have already priced that information into the market. Trying to trade off near-term news events is practically a guaranteed way to underperform. True long-term wealth building is about understanding businesses and economic fundamentals. It's not about trying to front-run the evening news.
Okay, Section 3, peering into private credit.
So the crucial point here is understanding how this massive $2 trillion space evolved in the first place. After the 2008 financial crisis, traditional banks were hit with really strict regulations, and that forced them to abandon a lot of riskier business lending. while private credit firms gladly stepped right in to fill that gap. They raise investor capital and lend it directly to private companies, charging pretty high fees along the way. Now, while it certainly offered higher yields back when interest rates were low, it's a highly illiquid space with incredibly opaque, self-reported valuations. There's simply no secondary market where these loans are actively priced day to day.
And that opacity is really starting to become a problem as higher interest rates take a bite. Because most private credit loans are floating rate, the borrowing costs for these businesses have absolutely skyrocketed. We are now seeing default rates among corporate private credit borrowers push up to a massive 9.2%. That's higher than the pandemic peaks. Massive funds run by industry giants like Blackstone and Blue Owl have actually faced surges in withdrawal requests from nervous investors. This has forced them to activate gates, which basically means they halt or restrict investors from taking their money out. It really highlights the severe illiquidity risk that's hiding just beneath the surface of these alternative investments.
Let's pivot to Section 4, Geopolitics and Your Portfolio.
We can actually distill these massive global headlines into a really clean overview of objective economic risks for your portfolio. Take the conflict with Iran, for instance. Because Iran borders the Strait of Hormuz, which is where a fifth of the entire world's daily oil supply flows, any escalation there has already spiked oil prices near $90 a barrel. A prolonged disruption could mean surging fuel costs, and that directly translates to sticky global inflation and potentially higher interest rates for longer. Looking closer to home in North America, we have to push for Alberta's separatism. Economically speaking, creating a landlocked nation would introduce massive trade barriers. We're talking about potentially costing the region $20 billion annually and sparking serious capital flight. And what about the proposed $25 billion Canada's Strong Sovereign Wealth Fund? Well, it faces heavy execution risk, especially given the history of cost overruns on similar projects. Plus, it presents a significant concentration risk for any retail investor who heavily ties their capital to a single, localized policy initiative.
Let's move to and see how this builds into Section 5, Actionable Steps for Investors.
We can explicitly break down all these complex digital and macro threats into a really simple 4-step checklist for you. Step 1. Verify credentials. If someone is giving you financial advice, you need to ensure they are a registered fiduciary with a legal duty to you, not an AI and definitely not an influencer selling a course. Step 2. Ignore short-term headlines. Your long-term portfolio should absolutely not be radically altered just because of a breaking news alert. Step 3. Avoid gamified trading. Recognize prediction markets and prop trading firms for what they really are. They're entertainment and gambling, not reliable investment strategies. And finally, Step 4. Diversify globally. Please don't concentrate all your wealth in one single geography or sector, especially in the face of rising geopolitical tensions.
Just to quickly summarize the core lessons from our framework today, always remember that AI chatbots and social media personalities have zero fiduciary duty to your financial well-being. Prediction platforms are offering you casino odds while masquerading as an informational edge. That $2 trillion private credit market, it's hiding significant illiquid and opaque risks right now as defaults rise. And finally, the sheer volatility of global geopolitics absolutely demands broad, long-term diversification rather than reactive panic day trading.
I'll leave you with this final, really vital question. In a market that is practically engineered to distract you with noise, gamification, and panic, is your portfolio truly designed to weather the long term? Don't let algorithms, influencers, or geopolitical anxiety dictate your financial future. Take the time to review your true risk exposure today. And if you are ever uncertain, go speak to a registered fiduciary who can help you confidently stay the course. Thank you so much for joining me in this explainer. Stay focused, stay disciplined, and I'll see you in the next one.